Welcome back. Now, the South African Reserve Bank has cut interest rates by 25 basis points, this bringing some highly anticipated relief for the property sector. The cut takes the repo rate down from its 15-year high of 8.25% and follows an improvement in the country's inflation outlook. Old Mutual Investment Group's head of listed property and portfolio manager, Evan Robbins, joins us now to unpack how the property sector has received the MPC's latest decision. Evan, thanks so much for joining us today. Now, before we get into the latest rates decision and how it will impact the property market, I want us to just reflect on the property sector's performance. This sector has been unloved for a couple of years, but moving over into 2023, we did see it outperform most of the asset classes on the JSE. Let's start there. Take us through some of the pressure points the property sector has felt in the past few years and how that recovery started gaining traction through last year.
Okay, well, probably started weakening before COVID. The fundamentals were poor. It was oversupply. When COVID came along, it really hit property hard, the property sector, far worse than other listed sectors that recovered probably never did. However, over the last year or so, we've seen a sharp recovery in property. Still, in the longer term, not near the other sectors that have fully recovered. Probably still down from before COVID, but remarkable recovery in the last year, 36% in total return terms over the last 12 months, most of that this year. That's on the back of market understanding that property fundamentals aren't deteriorating, in fact, getting better. And before that, just as you said, unloved, expecting to continue to deteriorate, possibly. And a large part of it is just the improvement on the SA outlook with bonds strengthening, and that's related to the election and all those positive factors and more positive SA factors, which obviously property has been a beneficiary of.
Now let's unpack those fundamentals a bit more, considering that the recovery is proving to be sustainable this year, and also considering that those rate cuts only started coming through in the third quarter of the year. So surely it's the fundamentals that have kept, the momentum going.
I think the fundamentals, certainly, the market started appreciating the improvement, I think, at the end of last year. We saw probably strengthening in its own right then, and that, I think, was on the back of people looking at the situation, things are not this bad. Things have troughed, which is a positive from things getting worse to things being stable, and now things are improving. The market does look forward, so the rate cut we had was fully anticipated. What's more important is the bond yields that really drives the asset values of property. And those bond yields started strengthening after the election. And part of that, of course, anticipates rate cuts as well. But that's really been a driver, which is why we've seen very little impact since the rate cut itself, because it was expected. We've still seen some strength, but you can't just attribute it to the rate cut itself. We need more aggressive rate cuts to really start seeing and making a meaningful difference for property. But on the earnings side, obviously, it helps. Every bit of rate cuts lowers the interest payments for the property companies, which is welcome.
That's right. Now let's just zoom in on the different subsectors within the property sector. We've seen, the retail property recovering. We've also seen industrial property continuing to be the winner in the sector. But we have the office property as the laggard there. Do you think we're at the bottom of that downturn cycle, considering that, there are prospects that the economy is improving and we've had, less load shedding?
That's a big debate. What's interesting, it is now a debate. Are we at the end of that cycle? Before, it wouldn't be a debate. I'm not prepared to say that yet myself. But we have seen in offices, which are the worst sector, we had the latest industry statistics on Bochum's vacancies coming out last week. And for the 9th consecutive quarter, office vacancies were down. They've been down consistently, not to where they were before, but they've been about 300 basis points reduction in vacancy rates, if I'm not mistaken. So again, seeing a steady improvement in office vacancies. It's not enough to start driving any pricing power and any pockets of areas with a lot of oversupply. But yet, even offices, we're seeing fundamentals, and includes rentals, looking better on an aggregate level.
What I find interesting about the office property sector is the trends around semigration, where you are seeing, office property within the Western Cape doing quite better than office property in Gauteng. Talk to us more about the trends there.
That's very true. If you look at the office vacancy survey I referred to, Cape Town vacancies are, I think, 7%, and rule of thumb has always been at 5%. You've got some pricing power, but Cape Town, I think, is a different story. You can't extrapolate from Cape Town. In Cape Town, never had the building boom, you can say, that happened in Gauteng, especially around the Gautrain, which has been an oversupply issue. Everybody trying to put offices for all the right reasons near the Gautrain station, but they ended up with a clutter of offices and other offices going vacant. We never had that in Cape Town, and also Cape Town can't really sprawl too much because of its geography with the mountain and the sea. As many areas with that geographical constraint have the same thing, and Cape Town similar. If you look at the Cape Town CBD, it's not massive. It's really not massive, and there are little other CBDs as well. So it is a special case, which is certainly working in its favour, and of course, this immigration as well, as you mentioned.
I want us to go back or circle back to the industrial and retail property sector. As I mentioned, that the industrial sector coming out as the winner within, the property sector, as we've seen demand for warehouses, demand for industrial property off the back of online shopping just growing. Has this hampered demand for retail property?
I don't know if it's hampered demand for retail property. Obviously, it's been a beneficiary of a shift.
Yeah.
You can't have online delivery without warehouses. So, what's been lost there has been gained there. So certainly that industry and that growth in the industry is a direct result of that. And to the extent that the competitors are to some extent, that does come at the back of retail property. But at the same time, there's been very little retail property development recently, at least in the big areas. The underserviced areas is a different story. So we see there just, and over time, as spending power increases and compounds to some extent with the population, you start seeing better dynamics there with a little changed pool of shopping centres.
Taking all of that into account then, Evan, where are you seeing opportunity in the property sector at the moment?
So, the easy opportunities are less forthcoming now that things have increased quite materially. Some of what has been beaten down strongly maybe where the opportunity lies. Some of the companies that have got platforms and have got success competitive advantages, in the short term they look less attractive because everything else is catching up. But in the long term, those advantages should certainly hold them in good stead.
Evan, thanks so much for your time and just giving us analysis of the property sector and how it's been performing. That was Evan Robbins, Head of Listed Property and Portfolio Manager at Old Mutual Investment Group.